Okay. Is anyone in my group ready?
Yes.
Okay.
Yep.
Thank you. I
Yes,
will
yes.
start.
Okay. We're ready.
Okay. Thank you, everyone. Good morning, ladies and gentlemen. COVID-19 is like a big wave with destructive power. But can you imagine if there is a company which, instead of being destroyed, sees this as a wave to ride on? Amidst the pandemic, Indonesia has increased on
Factor as SMN poises to maintain its 20% market share, while smaller firms are still in survival mode due to price war. Smaller companies are suffering from the limited growth, low interest coverage, and low margins. We estimate that SMN will need to acquire 3,100 more towers within our forecasting period, while maintaining optimal capital structure. SUPR and SEN are the most potential candidates for acquisition due to their high tenancy ratio and similar client portfolio as SMN. Going forward, we see SMN's prudent asset management will maintain SMN's strong balance sheet with 3 times net debt to EBITDA and 0.6 times debt ratio. Besides, we expect that there will be an increase in the company's profitability. But what is the catalyst?
The third upside catalyst is a boost in profitability due to the low interest rates environment, as interest expense is a major cost driver of tower companies. Hence, a lower effective interest rate has been a competitive edge. Compared to TBIG, SMN's interest rate has been more than 20% lower. Among other factors, this is also due to the high creditworthiness of Jarum Group, with 51% ownership in the company. Currently, we are of the view that the expansionary policies in Indonesia will continue as the government is trying to preserve the economy. This will result in a lower cost of funds for SMN. We expect that the company's overall interest rates will be pushed down to 4.9%. These benefits will boost the company's profitability as shown by an increased net profit margin to 44%, which is much higher than the industry's average of around 28%. As a result, this will boost returns as the dividend yield is forecasted to increase to 4.4%. Given all these aspects, we will now see how these three catalysts are translated into a 35% upside potential.
We arrive at a target price of 14.55 rupiah per share with a blend of intrinsic and relative valuation approaches with an attractive potential upside of 35% from its last price of 1,075 rupiah. Our DCF analysis is driven by revenues via tenant growth and CapEx via tower growth as per this model framework on the left. We find a relatively low cost of capital of 8.5% thanks to SMN's ability to obtain cheap financing in addition to the current low interest rate environment, and a terminal growth rate of 3.5% with stress test on this assumption, resulting in a buy rating even if decreased to up to 2.5%, which is 1% lower. Meanwhile, our multiples pricing based on 6 peer companies, both domestic and international, finds historical undervaluation on both forward EV/EBITDA and PBV multiples. With regards to this, we find a major catalyst to close the gap in the Indonesian government's Omnibus Law initiative, which will allow international investors to become majority shareholders in Indonesian tower companies for the first time. In our view, foreign investment is imminent. SMN currently offers a 3.1% dividend yield at 10.9 EV/EBITDA, while our peer companies are priced at least twice that for half the dividend yields of 2.1% average, which makes it a huge opportunity to invest in SMN as the best company in this sector. The PBV analysis shows similar results towards ROE, where an SMN's return on equity of 30% is twice the peer average of 15%. We believe that this expected influx of foreign capital will unlock SMN's valuation going forward. Our scenario analysis of key drivers reveals a high upside potential of 49% in the case of rapid 5G adoption and limited downside potential of 16% in our pessimistic case. We also conducted a Monte Carlo simulation that supports our valuation with a 97% probability of buy based on distributions of key external drivers. As for the risks in our assessment, we view price risks, consolidation of telco companies, and the possibility of increased cost of debt as key risks. However, our simulation on these factors reveals limited downsides with a maximum of 5.3% downside risk in the case of very low lease rates. On top of that, SMN also excels on its ESG rating.
Guided by the MSCI framework, we see that SMN scores 3.5 out of 4. This high score is further validated by the fact that SMN is included in Indonesia's top 2% ESG leaders. Responding to its ESG risks, SMN has applied great corporate management. First, SMN consistently updates its environment compliance standard. Second, WHO confirms that radio waves transmitted from towers are safe and friendly. In addition, SMN also provides community liability insurance to protect local safety. Lastly, SMN is the only company that receives the Best Directors Award by Global Business Outlook. This high ESG performance will support sustainable growth for SMN going forward. All in all, we reiterate our buy recommendation with a target price of 14.55 rupiah, giving you a 35% potential upside that is driven by rising structural demand, potential for industry consolidation, and being in the low rates environment. Ladies and gentlemen, a big wave of data demand is on our shore, and we believe that SMN is ready to ride it for sure. We are Universitas Indonesia, and that concludes our presentation. Thank you.
Thank you. Judges, at this time, turn on your video. Please stay muted unless you are speaking. I will start time as soon as the judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Could you talk about a little bit about the risk to SMN from potential consolidation in the Indonesian telco industry? You showed lower tower growth, but what would the risk be that they end up with fewer tenants per tower if that were to happen?
Thank you, Judge, for the question. I want to take that question. If we may go to appendix number 71, we acknowledge that there will be risks regarding the telco consolidation. However, if we reflect on the major merger of XL and Axis back in 2013, we don't see any adverse impact in the revenue of tower in the next 3 years. However, with this merger, we can expect a stronger financial, so these telco companies can further expand. In this analysis on the right side, we can see the very limited impacts, which still show an upside potential to our recommendation.
In addition to that, we admit that consolidation, after the consolidation, they may not renew the leases, the telco. However, currently SMN has the longest average contract with 7 years average contract compared to TBIG 5 years and then SUPR 5 years. And we believe after the 7 years, which is 2027, the telco companies will start to invest more on 5G. And currently, SMN is the most ready company to invest in 5G deployment. So we see that the risk of telco consolidation is limited in case of SMN.
Just one follow-up. Do you know what the overlap between some of the likely merger candidates is of their tenants? Do two likely merger candidates both have tenancies on the same towers? Are you able to analyze that?
Yes. We have analyzed that, but we want to emphasize that the contract that already been made for this telco companies cannot be canceled until the end of the contract. So we see if the average contract is 7 years, we see there are a long time for the companies to not renew the contract. And there's in its contract itself, we see there's a possibility for if there is one tower which has 2 tenants, there's a possibility to move to other tower. So we see that the risk is limited.
Thanks.
Hi, I have a question on slide 16 on your, basically on your estimate. Given that you just explained that the market demand is growing and they're gaining market shares, and then we're in a low interest rate environment, why did you model that both your EBITDA margin and net profit margin flat over the next four years, I assume?
Hi, I have a question on slide 16 on your, basically on your estimate. Given that you just explained that the market demand is growing and they're gaining market shares, and then we're in a low interest rate environment, why did you model that both your EBITDA margin and net profit margin flat over the next 4 years, I assume?
Sorry, thank you for the question. So we do, if we take a look at the profitability slide, please, on slide 11. So it's true that on overall, it seems that the margin is flat overall forecast period. This actually is from pressure from above and also from below. So in terms of the revenue, we acknowledge that the revenue will be growing, and the diversification of the telcos of the tower business is going to affect in terms of the fact that currently the margins for the fiber optics business actually is lower than the margins for the tower business. So this is going to cause some pressure. However, this is going to be compensated by the sheer growth of the industry itself. And we think that this investment that SMN has been doing into the fiber business is necessary for it to eventually win out in terms of market competition. As 4G and 5G deployment is continued, fiberized towers will be better for tenants. And other than that, there's also the factor of the price war, that has been going on in the telco industry, which, as we can see, has been causing a decline in the lease rates in tower industry. So this is also going to affect in terms of the P times Q. The P has been declining for the last 5 years. However, we estimate that this will end throughout the middle of our forecast period, around 2022 to 2023, as the telcos finish their mergers and will eventually stabilize. So that is why the margins have been a bit flat in our forecast period.
Thank you.
Hi, let me ask you a question. So you emphasize that lower interest rates will lead to increased profit margins, but you also emphasize that this company has low debt to EBITDA and good interest rate coverage ratio. So why would assuming that interest rates go lower, should we buy this company? Shouldn't other competitors or other companies be wouldn't more benefit from low interest rate environment, assuming interest rates stay low?
Thank you for the question. And if we may go to appendix number 52, we see that the first reason regarding the industry, we see that in the low interest rates environment, the tower industry will benefit, as we can see that their net debt to EBITDA comparison here with the other industry is quite high. And if we zoom in into the industry itself, we can see that SMN still has the lowest net debt to EBITDA. Meanwhile, the other companies, the other main players here already reaching their limit. So what we are going to point out here is that even if the low interest rates environment, the other companies will not be able to take benefit from here, since they already have limited debt headroom.
And also for some additional context, can we move to the tower internet coverage map? So this is the thing that we believe will be the opportunity that can be captured here, while other companies cannot capture the opportunity of providing towers in the other islands that other than Java or Sumatra. Only SMN is big enough and have enough room to capitalize on the situation, on the expansion of 4G, the expansion of 5G, and other technologies.
Thank you.
Just a quick question on your relative valuation and the peer group. So a number of other countries also have tower companies. So did you sort of compare with the similar economies like emerging markets, and what other sort of longer term multiples you're seeing in those economies? And compared to that, what's the multiple you're applying here?
Okay, so we could take a look at slide number 14 for the multiples. So our consideration for the peer group, first of all, is that in this peer pool, the Indonesian company other than SMN, which is the topmost one, is actually TBIG, the one below it. And we only used one peer company from Indonesia because the other tower companies in Indonesia are relatively very small, a lot smaller, with only several thousand towers compared to 21,000 towers for SMN. So for the other industries, we take a look at the companies which are independent, because in terms of multiples, the multiples from, for example, China or India, which are mostly government-controlled companies, are a lot lower, and this is because of the control the government has over the tower companies there. So our consideration is that we think that the restriction on the foreign investment in tower industry, in terms of the tower companies being included in the negative investment list, so foreign investors are not allowed to be majority shareholders. This has probably affected the multiples quite a bit, which is why we see a historical undervaluation on domestic tower companies, both SMN and TBIG. However, we think that after the Omnibus Law is implemented, this will be a game changer for the tower industry in Indonesia, as it will allow foreign investors to finally capitulate on this market. And we think that this is the thing that will finally close out its valuation gap. And as we can see here in economies in the US and in Europe, the multiples for tower companies are priced at 20 times net debt to EBITDA compared to less than 15 times in Indonesia. So our consideration is that we think this key regulation will drive up and close out the gap on the valuation in terms of market multiples.
And to close the answer, again, the peer multiples are chosen based on the independency characteristic of each of our companies. And then to conclude, we again reiterate our buy recommendation with a 35% potential upside.
Okay, thank you.
You highlighted lower interest rates as a key advantage, but when I look on slide 15, it looks like your interest rates are in 2020 are already down at 4.9, and that's where you're projected they're going to stay. So it doesn't seem like it's really going to add a lot, or am I missing something in that chart?
We have calculated the impact.
Time. Thank you to Universitas Indonesia.